Good afternoon, ladies and gentlemen. Welcome to the CENTAMIN PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish responses on the Investor Meet Company platform. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. I'd now like to hand over to Martin Horgan, CEO. Good afternoon.
Thank you very much, Mark, and good evening, everybody, and welcome to this CENTAMIN Retail Investor presentation. As mentioned, I am Martin Horgan, CEO, and delighted today to be joined by my colleagues Ross Gerrard, CFO, and Alex Bartikars, Head of Corporate Comms. Just moving on to the disclaimer, which I'm sure you will all no doubt have read at your pleasure. I'm just going to open up with a quick review of our portfolio. Delighted with this picture and the changes that have occurred to this over the last little while as well. When we look at that, what I see there really is an integrated pipeline of organic growth opportunities for our business. And I think really exciting for us across two of the great geological terrains of the world from gold exploration perspective. We've got the Birimian in West Africa, and of course the newly emerging Arabian-Nubian Shield in Egypt, and across into Saudi Arabia as well. I think that really underpins our belief in the drill bit and how exploration really is the engine room of our industry, and of course, by extension, the centre. I think, as I mentioned earlier this year as well, the other thing I'm delighted about, of course, with that slide, is that for the first time now in the company's history, that also contains non-Sukari reserves on that slide as well. And really what I see is a base to build from, and build our business and our vision of trying to develop a multi-asset, multi-jurisdictional company. As I say, I think in terms of the opportunity to build on the success of Sukari and deliver that organic growth of opportunity through Doropo, and then with the opportunity in EDX, I think there's a real exciting future ahead of us. A fairly common slide that you'll have seen over the years, and one I'm said that we're consistent around in terms of our strategy of how we intend to develop CENTAMIN going forward. Clearly, the first bucket is that value maximisation at Sukari, our primary asset in Egypt. And of course, onto the second legs around growth and diversification. That's growth both in Sukari, but also in Côte d'Ivoire, giving us that diversification as well. And of course, throughout that journey, remaining committed to stakeholder returns. And Ross will talk a little bit later about our continued commitment to our dividend policy there as well. Alongside, of course, that, how we've been delivering that over the last sort of 3.5 years. I think we've done an awful lot of work over the last 3 years, and it's really the opportunity to put this slide together causes you to pause and think about how much work we've actually done. When we're looking back to 2020, when we think about the first phase of work as I've joined the business, it was all around that initial sort of review of Sukari, that first point of the optimization work, and that's sort of what we call the life of asset phase 1. Moving into 2021 then, we continue to develop and understand our geological approach to Sukari, and that led us back to the life of asset sort of phase 2 update, where we believe the roadmap back to 500,000 ounces. But importantly as well, starting to look at the rest of the portfolio, the ability to Doropo as a development opportunity. And of course, that work with the government around the Eastern Desert exploration opportunity within broader Egypt, and the ability to secure those 3,000 kilometres of new ground across the Western Desert. In terms of Sukari itself, back into 2022 now, with that increased geological knowledge and confidence, allowed us to transition to owner mining in the underground, supported by that 33% increase in underground reserves. We commenced field work across the Eastern Desert of Egypt. And of course, and corporately, a big step forward and a big change for us was securing that $150 million RCF facility with a group of leading international banks. And on to this year, the latest life of mine plan, the final iteration that we've released a couple of weeks back. Now the finalisation of the regulatory framework for Egypt and the first drill programme across EDX, the completion of the pre-feasibility at Doropo and immediately commencement of the feasibility work and the ESIA, and of course that ability to put some gold price protection there as well. We've covered a huge amount of ground in the last 3 years. I think what we're starting to see now is the benefit of that work coming through there as we look to really optimise that portfolio and deliver that vision for a multi-asset, multi-jurisdictional producer. I think in parallel with that, however, one of the things we've looked at is to make sure that we have consistency of delivery. I think that was one of the first challenges that was put down to me when I first joined. Can we optimise the portfolio, but in parallel with that, can we get Sukari operating on a consistent basis? I'm delighted to say that as we sit here today, we remain on track for this year's guidance. In terms of our production year to date, We're still maintaining our target of the 450 to 480,000 ounces, albeit now at the slightly lower end of that target range. Delighted with the cost performance, absolutely fantastic year to date at 1240, just at the bottom end of our guidance, clearly targeting the bottom end there as well. And in terms of CapEx, a really solid investment profile put into the year as part of that 3-year rolling plan, which is going to roll off very shortly, and allows us to maintain our guidance, but bring some earlier projects early into this year as well, which Ross will talk to a little bit later on as well. So a really strong performance across that, and the focus on delivery at Sukari, alongside that portfolio optimization as well. And with that, maybe I'll hand across to Ross.
Thank you, Martin. Good evening, everybody. Core to our strategy is our financial strength and maintaining a robust balance sheet to fund that growth and our company objectives. As you would have seen with our third quarter, we finished the quarter with available liquidity of $276 million, which, as you can see, is comprised on the pie chart of cash and cash equivalents of $79 million, our financial instruments valued at $11 million, bullion on hand, $23 million, and our gold and silver sales debtors of $14 million. With the good operational results to date that Martin mentioned and resultant cash flows generated, we've been able to fund investments from both corporate and cash flows during this elevated period of reinvestment without drawing on the $150 million RCF facility. So from an overall liquidity standpoint, the $150 million RCF represented in grey remains fully available and provides that total liquidity pool of some $276 million to work with. We also implemented a gold price protection program, which supports the remainder of 2023 and the first half of 2024 cash flows, providing more certainty and further balance sheet flexibility over the remaining tail of our peak reinvestment period, which is scheduled to finish in mid-2024. Talking a bit about our capital allocations, we've been very clear that this is our last full year of a significant 3-year reinvestment program in the Sukari mine. 2023 has an elevated level of growth CapEx of some $273 million, which was budgeted for this year. As a number of those studies and these multi-year projects move towards completion, we expect the CapEx to reduce from 2024 and beyond. In terms of our main 2023 key projects, the accelerated waste stripping program is now 80% complete. Underground development is on schedule. Our numerous drilling as part of our EDX program is complete, and fleet expansion purchases have been accelerated into 2023. Our grid power connection is expected to be complete at the back end of 2024, and the gravity circuit continues to be advanced. I think it's important to highlight that with the good performance during this year, we've been able to deliver these projects without utilizing the RCF, and actually been able to use the good performance to date to bring forward almost $20 million worth of CapEx, originally scheduled for 2024 into 2023, and to maintain our annual guidance of that $273 million that I mentioned. And that mainly relates to fleet purchases, acceleration, and the power line deposit in terms of the grid tie-in. I'm always delighted to talk about the commitment to shareholder returns. This will be our 10th consecutive year of dividend distributions. As Martin mentioned, we recently strengthened our dividend policy, which is to continue to use group free cash flow generated and applying a 30% minimum priority payment of those dividends, dividend calculation to those cash flows, but now calculated before growth CapEx. This is to be funded by debt or surplus cash flows. And thereafter, any surplus cash flows would be assessed against both balance sheet requirements and the application of further shareholder returns. As you would have seen from the interim dividend, the board decided to distribute a total of 53% of the first half group free cash flow before treasury funded growth CapEx. And you'll see on the right-hand side of this slide, that was calculated by taking group free cash flow, adding back the growth project CapEx that was financed from treasury of some $21.8 million, creating a pool available for cash flows, available for distribution of $41 million, applying that 30% minimum distribution per dividend policy, and then assessing that surplus cash flow for discretionary capital allocations and applying a board interim dividend supplement. So in summary, the board applied that minimum 30% of free cash flow and then took a further third of surplus cash flows available, rounded up to 2 cents per share, which was taken as a dividend declare. This is a clear illustration that we've been able to apply an enhanced policy which applies both objectives of financing our growth opportunities, but also maintaining consistent and sustainable shareholder returns, particularly over this period of significant reinvestment. I'll now hand back to Martin, who will talk a bit more about the Sukari mine in more detail.
Thanks very much, Ross. So I was asked back in 2020, why did you take the job at Centamin? The opportunity arose. Why did you take on the CEO position? I think, to be honest with you, one of the great sort of drivers for me was the opportunity to work at the Sukari gold mine. People often talk about sort of tier one assets, these world-class assets, and I genuinely believe at the time, and even more so now, I believe that Sukari definitely represents one of the world's greatest gold mines. It's a world-class ore body, and I think the challenge for us then at that point was to put a world-class mine around that. And I think that's what we've been busy over the last 3 years looking at. And really the intention, of course, was to have Sukari reset and optimize and consistently performing Sukari to be that engine and that foundation that allows us to realize both our growth aspirations, both in Egypt and Côte d'Ivoire and elsewhere, and also, as Ross has mentioned, maintain that commitment to be able to provide dividend on a through the cycle basis. So with that challenge in mind, we broke Sukari down into a number of constituent parts. We've analysed each of one of those parts, and we put them back together. And we were delighted a couple of weeks ago to announce the life of mine plan, and delighted even more than that with the results that we found. So people talk about tier one assets, and what is that a bit? At least 500,000 ounces of production, lower half of the cost curve, and at least a 10-year life. I'm delighted to say that we've been able to tick all three of those boxes as part of that life of asset review that we've done now with this latest optimised revision of the plan. So gold production sits at just above 500,000 ounces over the period of 2032. Drops down a little bit in the last 2 years, and hence drags that average down, but certainly an 11-year life of mine. In terms of the costs, I think that was fantastic. Delighted that as an outcome. On that life of mine basis, seeing that sitting at below the 1,000, the cost curve 50th centile at the moment sits about 1150, 1200. So that's well inside that 50th centile. And as I mentioned before, of course, that 11 years. And of course, we believe there's good opportunity to further improve on that with further geological success, both inside the concession, and I think importantly and excitingly, outside the concession, around the Eastern Desert exploration work we're doing near to Sukari as well. So I think that's a fantastic result and really has repaid our faith in Sukari and really sets us up as a real engine with which to drive our strategy forward as well. So let me take a little bit of a closer look at what does that actually look like in terms of the plan. Well, clearly here we have a graphical demonstration of the ounce profile over the remaining life of mine, and of course that all-important all-in sustaining cost that works with that as well. So a couple of things that stand out to me on this basis is firstly that we have the darker bars, which represent our life mine plan based on reserves, and then we have the lighter coloured standard bar sitting on top of that as well, and that's where we've assumed that there is resource conversion from the underground mining operation as well. So the first thing that jumps out to me is that, as you can see there, is that the substantive part of our life of mine is now fully based on reserves, and certainly out to the end of this decade. And then we start to see some of that underground resource conversion come in to effectively maintain that 500,000 ounce profile as well. So gives us a great sense of confidence in the next number of years, and plenty of time to target that work to convert that resource, even grow that resource, and then convert that to reserve to top of that plan as well. So I think that's an excellent result for us, and really gives us a great deal of confidence over the next decade to push on with Sukari as well. I think, as I say, the 500,000 ounce level, I think we've well flagged that heading into this work. We felt a good deal of confidence over the last sort of 12, 18 months we could get to the 500,000 ounce mark. But I think the big surprise is around that cost base. I'm delighted to see that coming in there, and that really sort of excellent profile that gives us that through the cycle ability to generate excellent cash flow from the assets in a range of gold prices, and allow us to both deliver that growth and stakeholder return targets for us as well. Just bring us on to the cost curve. As I say, this is the 2025 forecast cost base for the sector. As you will see, this is an asset-only basis. This doesn't include the corporate overhead from there, as this is an asset-only global cost curve. But from where we were in financial year 2022, you can see there we were in the top quartile of cost mines at that point in 2022. And then as we forecast into 2025, when we see some of those projects coming on stream that we're just finalising right now. That sits us at just over 1,000 at 1,042, and well inside that 50th centile. And then when we take into consideration the full life of mine costs, which of course benefit from those lower costs towards the end of the mine life when you're through the stripping and the underground development, that's a really impressive 922 average, which is inside the bottom quartile as well. But I think that's a fantastic achievement. I think that to me is one of the great successes of this latest iteration of work there, to really place Sukari in the right part of the cost curve to generate strong cash flows right through the gold price cycle and help to support that business case as well. So I think that's an excellent piece of work. And I guess the question was, how did we derive that life of mine plan? What has changed effectively? Well, actually, I think, it's relatively simple. And I think that's always a really strong point, actually. There's not anything particularly clever that's been done about this. I talked back in 2020 about focusing on people and processes. They would drive that cultural change around how we're looking to reset the business. And with that cultural change, we then look at sort of ensuring that we base the business on sound principles. And from a planning perspective, that meant having long-term plans driving short-term targets. And it meant getting really good data, collecting that data, and then using good engineering and science effectively to do bottom-up planning that drives supportable and realistic plans as we go forward. And that really has been the secret to this whole process here. In terms of the work done itself, we've started to move away from reliance on external consultants. We've increased our in-house capacity. So we're always looking to make sure that we own these plans. We have to deliver against them. We get them externally benchmarked and reviewed by expert consulting and engineering groups, but really there's a sense of ownership with these plans as well, which I think is important. In terms of input parameters, we've been consistent with our gold price. We've assumed 1450 for the last 3 years. We continue to assume 1450 for the long-term gold price. We haven't played with any of the inputs there. On an operating cost basis, we've taken the 2023 cost base and we've rolled that forward. We're not assuming there's any drop-off in the cost base at all as, cyanide or grinding media return back to historical levels. We've assumed that the inflation that we're seeing baked into the current prices stays here for the medium term as well. And I think importantly, and one of the key drivers, of course, there is around diesel price. In the previous iteration of the plan, we'd used about 50 cents per litre, which was the spot price at the time. And in terms of this long-term planning exercise now, we've moved that up to 75 cents a litre. And we think that's a long-term defensible plan and underpins a prudent ascent to the parameters that we use for that as we go forward as well. So delighted with that. We think it's good engineering, good science, put together by an owners team, externally reviewed, and using sensible long-term defensible inputs as well. And then when we look at the individual components that make up the plan, we've talked a lot in the past about a focus on geology. It really is the bedrock of the business. If you don't get the geology right, nothing else flows from here. We thought initially that would give us a better geological understanding, leading to better planning and better execution, and it certainly has done that. But also it's given us that great growth, and we've added over 2 million ounces to reserves over the last 3 years as well, which is an absolutely fantastic result by that geological team. So looking deeply unsexy is around the geotechnical framework of the mine plan. We've put a lot of focus on that since I've been on board. We spent about $3 million between some specific geotechnical drilling and to get the life mine parameters that we needed for the full life cycle of the open pit planning. And alongside that, builds a full structural model to really make sure that we understand the environment that the Sukari open pit works within. And of course, the other thing we've done is constructed and now commissioned a paste fill plant, which allows us to operate the underground in a more safe and efficient manner, but also allows us to tackle some of the legacy voids that the open pit interacts with as it reduces down as well. So we've got a much better understanding of the geotechnical framework as well. And that's given us a real advantage, which I'll talk to in a second. In terms of the mining itself, well, we fully engineered the underground expansion plan. We flagged that as a pre-feasibility study last year. We've now done that work. We've completed that. And we're pretty happy that we can see ourselves step up from the current about 1 million tonnes per annum coming from the underground of run-of-mine ore up to about 1.4 million tonnes now at steady state over the next 2 to 3 years as we ramp up as well. But I think the big step forward has been around the open pit. We'll look at that in a little more detail in a second from now. And in terms of the projects, the big two there, of course, the big three, I should say, sorry, solar plant that's been delivered, and that's there for us now. It's been about a year in position now. saves us about 22 million litres of diesel a year. That's about $18 million in realised cost savings, and about 60,000 tonnes of CO2 equivalent as well. So a really successful story for us around our decarbonisation strategy and also cost saving as well. And as we look forward to the future, the grid connection, again, which we'll come to, the ability to continue to reduce operating costs and carbon emissions, and around that gravity circuit, which should allow us to optimise the process recovery, increase the ounces as well. So I think that's been a really good piece of work there, from basically bottom-up first principles, long-term plans, driving short-term targets. And that's really the framework at which we've been able to deliver this life of mine update, and that confirm that tier 1 status as well. But maybe looking at a couple of areas now of where those changes have come, and really with a focus, I guess, on costs. So I talked before about the geotechnical environment we're working in. Put simply, with better geotechnical data now, we've been able to steepen the open pit slopes up a little bit, predominantly in the north end of the pit. In addition, with having now paste fill available to us, we've been able to sort of deal with some of those legacy voids and actually change the shape of the open pit as well. And by doing that, we've been able to pull out about 160 million tonnes of waste out of the open pit plan. So we use kind of rounding numbers of about $2 per tonne for an open pit operation per tonne mined and moved. That's about $320 million of cost out of the open pit over the life of mine. And that's absolutely fantastic. You know, that is a real benefit to the business. So the $3 million on geotechnical engineering work, plus the construction of the paste plant, which is about $20 million, has enabled, in this case, to save $320 million of operating costs as we go forward. So that's fantastic. And of course, there's additional benefits, reduced carbon because we're moving less waste. And actually, it's had a nice flow-on impact as to how we manage our open pit fleet. And it's actually reduced the requirement for further capital investments in the open pit fleet. We're now with reduced volumes of tonnes of waste to be moved as well. But the other thing it did for us was allow us to redesign the pits with some slightly steeper stopes now, allowed us to access them all earlier. And what you've been able to do for us now is it allows us to bring some of those ounces forward into the mine life as well. The graph on the bottom left-hand side there was the previous plan. We need about 11 million tonnes a year from the open pit, and you will see that there is a shortfall from the period 25 to 29, where we're not able to fully fill the mill with open pit material, and historically we have been running on stockpile material. Fast forward to the new plan now, with those steeper slopes, with that earlier access to ore, we'll be able to bring those open pit tonnes forward, and as you'll see now, we run substantially less on stockpile material as well. So we've saved waste, dollars have come out of the plan, it's allowed us to bring ounces forward, gives us better consistency of mill feed, better ounces, and now we're dividing a lower number of dollars of operating costs by a high number of ounces, and helps to really drive those cost savings that I mentioned before on the all-in sustaining basis, which is fantastic. And that really is neatly sort of encapsulated by that graph on the right-hand side there that shows the improved strip ratio that we've seen previously to the new plan, and certainly at the front end of the plan as well, which is fantastic. The other big cost component was around the grid connection. Sukari uses about 50 megawatts of power a day, of its base load. At the moment, we're using obviously diesel generating equipment, diesel gensets, and we've got, they provide that base load of 50 megawatts. During the daylight hours, we're about 30 megawatts of solar and about 20 megawatts of diesel. That's about 8 hours a day. And then the balance of the day, the other 16 hours, we're purely on diesel. So in terms of exposure to diesel price, in terms of CO2 emission, obviously the question is, can we beat that? So one of the things that we've been very lucky with is that Egypt has invested significantly over the last few years on its both grid power generation capacity, but also its distribution. So Egypt now has a internal generating capacity of about 55 gigawatts across the country, and has a base demand of about 30. So there's a significant amount of excess capacity within Egypt at this stage. On top of that additional capacity, that's blended between gas, a number of gas-fired units from Siemens, but also a significant amount of renewables coming into the grid through both solar and wind as well. So that's how Egypt's power generation has changed. In addition to that, we've got about 3,000 kilometres now of high voltage distribution around the country. And for the first time now in Sukari's history, we've now got a high voltage power line running about 20 kilometres for the mine site. So with that, we engaged with the Minister of Electricity, Dr. Shaka. We looked at the ability and the feasibility to do that, to connect to the grid. We believe we can do that. We've contracted through a tender process we've selected a preferred bidder, and having gone through some technical evaluation with that bidder, we now believe we can deliver this project for about $46 million of capital expenditure. And at current diesel prices, that's a $41 million per saving per annum going forward as well. So just over a 1-year payback on this project. Of course, given the fact that the grid uses gas and a fairly significant amount of renewables in it, we think the current renewables are around about 20% of the current grid capacity, and that's planned to be up to about 40% by 2030. But clearly using gas and renewables has a benefit compared to using diesel as well from a carbon emission basis. And as you can see there, really, we now fully displace diesel from power generating within the business, and thus remove our exposure to those diesel prices as we go forward. It really then just becomes about open pit, sort of the mining equipment as the primary diesel user. And of course, with that redesigned open pit and reduced waste mining tons, that further reduces our reliance on diesel as we go forward. So here we have the wonderful happy confluence of a really good ESG project that further delivers into our decarbonisation strategy and saves a substantial amount of costs as we go forward as well. So delighted with that. We plan to have the project constructed and commissioned into 2024, and that'll be powering the mine going forward from 2025. Ross mentioned before about CapEx. Clearly, there's been a significant reinvestment in the mine over the last 3 years. That was part of that investing for the long term. Obviously, the capital waste drilling, the capital waste mining so the project has been one of the big sort of pieces of work that we've had to do. A fixed volume, 120 million ton program with them. They've performed excellently and actually are slightly ahead of plan at this stage. But that rolls off in the middle of next year. So that is now substantially behind us. We've got our reinvestment in grid this coming year and additional trucks to round out the fleet capacity. And really, once we're through that, we're substantively into a more normalised sustaining capital program as we go forward as well. So after a fairly patient investor base over the last 3 years and significant capital reinvestment, we're now sort of 6 to 8 months away from that being substantially behind us, and then getting back to some serious cash flow generation and cash harvesting as we move forward with a reset Sukari. But really, we don't stop there. I think that Sukari plan is probably 90% of the value on the table at this stage. The number of smaller opportunities that we'll continue to look at in this sort of culture of continuous improvement we look at. We believe we'll continue to grow with resources and reserves at the mine site, predominantly in the underground at this stage. But we think there's plenty of opportunity there. And of course, that exciting ground outside of the mine lease area itself. We think we'll expand the dump leach. That'll help us to increase the ounce profile. Not substantively, but a nice maybe 10 to 15,000 ounces of additional ounces, at a very competitive cost as we move that material from there. We think there's a few smaller opportunities around further geotechnical optimization. I think we've substantially captured the large amount of that, but we think there'll be small opportunities to improve there. I think there's an opportunity around waste haulage from the open pit. With a number of tons to move up the life of mine, can we now do that more effectively, more efficiently, and save ourselves some dollars on waste mining costs as well further? Some further optimization around the processing plant. And the final thing, of course, is our solar expansion. And the opportunity there is to basically get ourselves onto 100% solar during daylight hours, leaving the grid connection purely for the hours of darkness. So 8 hours a day on solar and 16 hours a day on grid. And that will really sort of continue to sort of make additional cost savings and really help to drive towards that decarbonisation strategy from there as well. So lots still to do at Sukari. Delighted with that sort of the work we've done. We think we're very happy with the outcome. We're going to publish a 43-101 off the back of that. Happy to share that with the world and the market and really demonstrate the sort of the robustness and the resilience of the Sukari mine and identify those further opportunities as we continue to refine and improve the operation. So people have asked me over the last week or two as we've been doing some sort of investor marketing. So with Sukari, substantively the way there, where does the next step change come from in Egypt? Where do you go from there? And I think the reality, of course, is this opportunity that we have in the Eastern Desert, or EDX, as we call that here in the company. Over the course of this year, we've completed our negotiation process with government, along with our industry partners, Barrick. We've been just through about a 2-year cycle of negotiation with the government of Egypt. We're looking to obviously start or restart and re-energise the broader mining sector. We've all bid on common economic terms, so they're set at a 5% NSR royalty, 22.5% corporate tax rate, 15% effectively net profit interest government carry, and then obviously contributions to community development funds as well. So a pretty standard and solid set of economic terms. And over the last couple of years with our partners at Barrick, we both jointly negotiated the additional terms around the edges of that, around stability, sort of hierarchy against existing laws and dispute resolution as well. So we believe what we have now is a modern framework that will basically be attractive to the international mining community that should really start to see the sector picking up from here. And importantly for us now, set the framework for any discoveries that we make across our exciting ground within EDX as well. Three main blocks we're looking at. The Nugrus block sits around the Sukari concession. The red rectangle you can see there, that is the Sukari mining concession. So clearly we'd look to try and cover as much ground around that with the intention of trying to find a satellite feed that could come into and extend the mine life. And then to the north, we've got Umrus and Najd. They're two areas where, if we were to be successful, they would have to be standalone opportunities given their distance from the Sukari mill as well. Delighted to say that given our position in country, and given our confidence of operating there, we've actually started work. We started work about 15 months ago at Nugrus, a greenfields area. It's not very green, as you can imagine, but in the sense that there's been no discovery there before. This really was virgin territory. So back to first principles, grassroots exploration techniques. And through that, over the last 15 months, I've done the usual work of leg and soil sampling, mapping, follow-up sampling and mapping, and then to sort of have a target generation. Within that, we generated initially 7, which ultimately became 8 targets. We've actually just completed last week the initial maiden RC drill program across those 8 targets in and around the Nugrus block as well. So we'll be waiting now over the balance of this year for assays to come back in from the lab. And once we have those assays, we'll be obviously looking to share them as well. And clearly here the opportunity to try and find a target that could, of course, be mined commercially and then brought into the Sukari facility. And therefore, that means the barrier to success, or the hurdle rate for success within Nugrus for us is significantly lower than if you were having to build an entire mine from scratch as well. And some of the work we've done internally, we believe that something as little as a couple of 300,000 ounces of target at about a 1.5 gram type grade would be additive to the mine plan. Now, clearly we'd like to find something bigger, but actually it just tells you that with having the Sukari operation close by, within 20-30 kilometers away, means that actually what would constitute an exploration success is significantly lower for us within CENTAMIN as well. So as I say, results in the lab, we're patiently and expectantly walking up and down outside the maternity ward, waiting for those results to come through. And of course, once we've got those, we'll be looking to share those with you via the usual channels. I talked before about West Africa. When I joined the business, it was an exploration portfolio, quite frankly a cost centre, and not really any real strategic or operational direction to try and take those projects and turn them to account. And I think the key aspect here for us was around discipline, to try and assess those projects as quickly as possible to see if they had development potential, and if they did have development potential, move them on as quickly as possible, and if they didn't have development potential, look to drop them and save time and money and focus your efforts elsewhere as well. And so delighted that through that process, the Doropo project in northern Côte d'Ivoire came through to our mind as being something with some real development potential as well. So located up in the northeast of the country, not too far off the Burkina Faso border, has been in operation for quite some time. A relatively rural part of Côte d'Ivoire with limited infrastructure at this stage, but certainly an area that the government is very keen to see developed in terms of industry to help community development in that area. So in terms of the project itself, I talk about two things here normally. From a mining perspective and a technical perspective, it's a relatively simple project, a series of 8 relatively shallow pits, all with very similar geology and metallurgical properties. And they would be mined by using conventional truck and shovel. I think the deepest pit we've got to just about 100 meters, maybe 110 meters. and relatively small amounts of material movement up to 25 to 30 million tonnes per year. We move 130 million tonnes a year at Sukari, so you can see this is a relatively small operation. And a low to one strip ratio, that's 4.1 strip ratio there as well. So mining pretty straightforward, standard processing flow sheets, nothing particularly exciting there. Pretty good recovery on a non-refractory basis at pretty standard micron, grind sizes, 75 to 106 micron as well. Tailings in the standard line facility, and then connection to the national grid as well. So I think for power generation. So I think from a technical perspective, a pretty straightforward project, to be honest with you, nothing particularly sort of challenging about it. It does sit within this this rural, sort of relatively underdeveloped community, and I think the art of making Doropo work will be to ensure that we have where possible, avoidance strategies around impacts on local communities, and where it's unavoidable, to make sure that we reduce any impacts, and where we do have impacts, look for mitigation measures as well. And the secret, of course, of that is getting out early with your baseline and very early into your consultation phase as well. We're busy with the ESIA at this stage. That'll be looked to be submitted by end of year, with feasibility finished in the second half of into the first half of next year. In terms of the project itself, that pre-feasibility study, we see a nice project. A couple of million ounces of reserve, plus minus. Delighted with that. 175,000 ounces per annum over the life of mine as an average production level, and in excess of 200,000 ounces over that first 5 years as well. Pretty happy with the all-in sustaining. Again, in that right part of the cost curve that we're looking at. We think CapEx for construction, having benchmarked it across to a number of other operations, is sensible and prudent. I think we can probably beat that as we get to feasibility stage. And when you put that together, we see a pretty attractive opportunity with a pretty good IRR at a long-term price of 1,600. Your CapEx is just about your same as your NPV, which is always a good indication, and that 26% IRR meets our hurdle rates as well. So with that done, as I say, we've pretty much moved into feasibility study, and the intention is to have that feasibility study finished during the first half of next year, license application with government, and then I guess a financial investment decision, the FID, late 24, early into 25. And on the assumption that that is approved and goes forward, then we can see sort of first gold within about an 18 to 22 month period thereafter as well. So it's full down at Doropo, and that's a key component of delivering an organic, multi-asset, multi-jurisdictional producer. So to wrap up quickly, I'm sure everyone's sort of getting bored of me banging on here. This is what I really like. I love this chart. And from when I joined 3 years ago to where we are near now, this really encapsulates that vision of that multi-asset, multi-jurisdictional producer. It shows that targeting in excess of 700,000 ounces production in the middle of this decade and beyond. That gives us that growth opportunity both at Sukari, where we believe continue to improve the resource and reserve base, both inside and outside the lease, and then adding Doropo production, and of course in terms of that all-important all-sustaining target as well. Gives you production growth, political and country risk diversification at the right asset level, and ability to generate strong cash flows right through the cycle, and continue to fund that growth element while continuing to remain focused on stakeholder returns. So on that the investment case, I'll leave that slide on the screen at this stage. And with that, I'd like to hand over to Alex for any questions that you might have for Ross and I.
Wonderful. Thank you, Martin. And thank you to all the investors who pre-submitted questions, many of which were addressed during the presentation. So we'll take those as answered, but if you would like further clarification, please feel free to get in touch. And then first starting with the balance of the pre-submitted questions, and then I'll go to the Investor Meet live. So if anything else comes up, please feel free to submit it there. So Martin, Ross, by far and away the most frequent question we've received has been on the share price. One person particularly encapsulated saying the analysts published very positive reports on sentiment and the life of mine predictions are encouraging. And with gold price now approaching $2,000 or even touching it today, why is it that the shares are languishing at this low level?
Thanks, Alex. Yeah, look, we've just did an investor roadshow last week around our institutional shareholder base, and we met a number of our current shareholders and also potential new shareholders. We're always looking to try and find that marginal investor. Look, I think the sort of the conversations we're having with the analyst community, with bankers, with current investors, and even potential new investors, is that I think there is a high level of satisfaction with the work done. I think everyone is sort of excited for what Sukari can deliver. The fact that we're very close to the end of that sort of reinvestment phase or substantive reinvestment phase now, I'm very happy with that. I think the general feeling is sort of twofold around the price. One is that we find ourselves in a challenging UK equities market. I think the general sort of broker feedback and banker feedback is that a number of money managers and investors are facing redemptions and return to liquidity in terms of holding cash. So you are in a challenging mid-cap UK market. It's a scenario where trying to find marginal buyers is difficult. So I think that's the kind of the context, and Sentiment is not alone in that basis. And I think really unfortunately with the terrible events happening in Israel and Palestine right now, I think the BBC is part of its news coverage is doing a great job on educating a lot of people around regional geography. And of course people are looking at a proximity play with Egypt to that particular sort of a terrible conflict. And I think we're seeing a bit of contagion a bit of pressure on the gold price because of contagion risk around those Middle Eastern politics as well. One of our main investors from a large UK specialist resource investor emailed this afternoon. He said, right mine, right commodity, wrong location. And I think unfortunately that's where we find ourselves at this stage. I think just touching on that, the reality is, of course, is that the Sukari mine is a long way away geographically from northern Sinai and the border of Israel. So certainly in terms of our ability to operate uninhibited, that continues to be the case, and we believe that will be the case going forward. Egypt itself is a key regional ally across there, both for Western Europe and North America, as well as a number of the Arab states across the Middle East as well. So I think Egypt has a key strategic role here and has a lot of international support within that as well. So I think unfortunately we are catching the wrong end of the sort of concerns around sort of regional stability at this stage, and Egypt's role within that. The practicality of boots on the ground is a very different story, but I think when you put that sort of concerns and a risk-off attitude into a fairly sort of apathetic and weak equity markets, that we're seeing that share price performing or not performing as the case may be as well, which is hugely frustrating for us all. But with hopefully a reasonably quick resolution and a normalisation of the situation in the region, we'll start to see that sort of coming back from there as well. So no, as a significant shareholder myself, I think share everybody's frustration with that. But I think with a long life asset at Sukari, with the potential of EDX, with Egypt's importance in the region, I think we'll continue to operate Sukari and believe that will come back over time.
Thank you. And then just staying with that for a moment, do you expect the conflict within Israel and Palestine, do you think that could impact our life of mine inputs? I can only assume that's kind of cost inputs.
Yeah, I think operationally, no. I think that is fine. I think life of mine inputs. Look, again, I think, we talked about long-term planning cycles before. So hence, the use of a $14.50 gold price for your long-term, planning assumptions on open pit and underground. We're not plugging in $2,000 an ounce to try and drive the mine plan. Similarly, on diesel price, a long-term assumption of 75 cents. So I think on a life of mine basis, I think we're at the correct sort of prudent point of what are sensible long-term assumptions on current sort of, current sort of understanding of where the world is. No, so I don't anticipate that unless we see a structural change in the gold price or the diesel price, for example, then no, I think we've got the right prudent assumptions, and we can navigate that from there. So no, I don't really see that at this stage.
Okay, thank you. You stated a moment ago that you think the shares were cheap at this level. How many shares do the board and management hold, and could they be tempted to buy more as it's viewed as a strong show of confidence to the market?
Yeah, look, absolutely. I think, in terms of the always the question comes up. So I think in the first point, maybe just to separate management as Ross and I and the broader team, and then the board. So the board don't actually get awarded any performance shares. So as under the UK system here is that they don't get options or induce or sort of vesting of shares on performance as well. So any shares that the board hold, they have that purchased themselves. And if I think correctly, it's about 1 million shares, I think at this stage, sits within the board sort of more broadly. And for Ross and I, there's a couple of targets that is good governance. So to be at about sort of UK governance wants us to be at about 200% of our base salary in a core holding and building that up over time. Personally, I'm at about 60% of my annual salary at this stage in shares held. I continue to make on-market purchases where I don't hold inside information clearly. And obviously then also Ross and I benefit from a sort of long-term incentive plan, and around 50% of the performance of the equity element of that is linked to share price as well. So I think in terms of purchases ourselves, Ross and I have made a number of purchases over the last couple of years, and I can't talk for Ross, but going forward we'll continue to look to do so when appropriate and when able to do so. And as I say, a significant element of the compensation of the management team is linked to equity, and 50% of that KPI that triggered that is around relative share price as well. So I think I think we're all fairly fully invested in the business and look to share that pain as well.
Thank you. And then one more on the shares before we move on to some questions around the mining. But is the board considering a share buyback at these levels?
Ross, I'll maybe, given that sort of capital allocation framework, it's a bit with you.
Sure. Thanks, Martin. Alex, yes, just confirmation, share buybacks have always been considered as part of that capital allocation framework. I think as we've gone through this reinvestment phase and where we were, the use of funds and those allocations were more around that reinvestment. But certainly at current share prices and where we are, it's definitely part of the conversation. So yeah, absolutely in the mix and in discussion.
Thank
but
you.
It's got to be balanced against all that capital allocation in our projects. But certainly yes.
Makes sense. So then just moving on to the mining side, there seems to be some confusion. So on the life of mine presentation, similar to the one you just gave now, you stated that there was a 40% improvement in the life of mine strip ratio to 6.5 to 1 from last year's average of 10.8 to 1. However, the life of mine average for 2015 technical report was approximately 6 to 1. Please can you explain why today's strip is still a little bit higher, or today's life of mine strip is still a little bit higher than that last technical report in 2015?
Oh, okay. It was about 8 years ago. Look, I think there's a number of factors at play here. Clearly, we've put a significant amount of work into the geological understanding of the ore body. That's driven a number of changes in sort of the resource modelling, has led to the reserve modelling as well, and of course. Sort of as we've looked to understand that, helps to drive the sort of open pit economics. So I think there's a quantum leap forward in geological understanding. As I've mentioned, there's now full life of mine geotechnical information for the open pit. I believe in previous iterations they've taken available data and effectively projected that forward. So there may have been some sort of assumptions in there. I think we are now working on a very solid base as well from that. So and then of course. Sort of pit designs that come off the back of that changed geological model around ore modelling, and then also the waste modelling around that geotechnical, plus 8 years further mining and knowledge down the track from when that 2015 Policy 101 was done, is that it's sort of changed. I would argue that between 6 and 6.5 to 1, it's not substantively different. It's a little bit different, but I would argue that our 6.5 to 1 that we have now is based on a lot more operating data over the last 8 years, and a lot more current data around both geology and geotech as well. So it's actually, to me, slightly surprising. It's a real sort of endorsement of it, the fact that that sort of 8 years down the track, and there's whole new data there, is that actually we're coming out with a not very different number as well. But yeah, look, I think it's just a function of time and better long-term data and knowledge that allows us to come with a more accurate plan.
Great. Thank you. And then this is going back in time again a little bit, but in 2020, at the end of 2020, we announced that there was some movement detected in the west wall of the open pit. When was that fixed, and has that high-grade material been mined?
Oh, yeah, a long time ago. Those ounces that were sort of, deferred from the end of 2020, they were actually mined in early 2021. And in fact, that sort of localized area of instability, it didn't actually fail, but was actually an area of minor movement. That wall has now changed completely, to be honest with you. When we, if I can just go to this slide here, that's, I don't know if people are able to see the cursor, but underneath the eye of the Sukari there, that's where that incident, sorry, not incident, but that's where that instability, was identified. And that wall's a good 20-30 meters away from where that was as well. So that was an issue that was a very short-term geotechnical incident picked up in 2020. We took the prudent approach so as not to cause an issue. It didn't actually fail in the end. Those ounces were actually mined in 2021. And that wall has been moved back substantially as we've moved the process down and opened up the pit, and that is now ancient history effectively as we go forward. So no, I think that's not even an issue that we think about anymore, to be honest with you.
Great, thank you. And then just quickly moving to the grid. So, is there a risk that the electricity rates will be raised in Egypt?
Like everywhere, yes, absolutely, of course. Costs, we all know about inflation. Costs can move, of course. So yes, there's a risk to everyone's electricity bill here in the UK as well as Egypt anywhere. What I would say though is that the differential in pricing between sort of the grid connection and moving away from diesel is so significant that even a doubling of the electrical tariff that we paid in Egypt would still not make a substantive dent in those cost savings there as well. So yes, absolutely, and it would take a multiple sort of change in the sort of the rate paid before then actually that became uncompetitive economically with diesel. You'd still get the carbon benefits of it anyway, and of course reduced volatility to the diesel price, which is one of the issues that you face from time to time as well.
Thank you. And then just a question on Bati West, or our assets in Burkina Faso. So the company indicated that we'd relinquish the licenses. However, it was noted that in 2023, there was to the tune of $775,000 of further costs attributed to Burkina Faso. Where are we with regards to the process of fully exiting the country?
Sure. Well, look, like any good corporate citizen, you don't just sort of down tools and walk out of the country. So there was a process, decision to relinquish, at corporate. One then engages with governments and notifies them. And then there's a process of effectively handing over data, getting the data, the core shares, all those bits and pieces together. They effectively belong to government, writing reports in terms of handing that back as well. So there's a whole process in terms of a formal handover of the sort of the data and the information to government. There is any minor rehabilitation work required around sort of field camps, and then of course there is the proper treatment of retrenched workforce, where one then sort of ensures that its workforce is treated in connection in line with local labour law, and people are given proper and correct redundancy payments as well. And then finally, of course, there are legal fees around the sort of the winding up itself in terms of making the regulatory filings required for that as well. So unfortunately these things certainly in the Francophone Code of West Africa as well, it just takes a bit of time to do these things properly, and we want to do things properly. We don't just want to drop things and walk away and leave that as well. We are acing the country in an orderly manner, making sure that we do things correctly, because Africa is a small place ultimately, and how you behave in one country very quickly gets done elsewhere as well. So there will be some legacy costs bleeding into this year as we look to make a proper and correct exit from Burkina as well. But I think that should be substantially done this year calendar, and then should not be any further costs going forward with that.
Thank you. Ross, one for you. How much does the Central Bank of Egypt owe Centamin for gold purchases?
This is a very interesting question coming through, but it's a very insignificant amount that comes through in terms of the amount that's owed. So basically, just to clarify that question, there's gold and there's an arrangement in terms of foreign currency that we have with the central bank. So the central bank doesn't owe us any significant amount of money, but basically what happens is that we sell gold across and exchange our US dollars for Egyptian pounds. It's all arm's length, and it's done under an arm's length wholesale agreement. But basically, there's a very nominal amount that was owed, representing a couple of $1,000 net receivable in EGP. I think it was to the tune of about 15,000 to 16,000 US dollars, and that was timing in terms of when the transactions were closed off.
Thank you very much.
It's fully disclosed in the annual report if you want to look at the terms of the arrangement.
Yes, thank you. So conscious that we're coming up to the hour, and I still have a handful more questions to get through. So I'm going to just quickly turn to the Q&A on the investor meet. Please, can you confirm if your aircraft geo-mapping at Sakari was extended over EDX, or do you intend to do so?
We have not yet done any airborne surveys outside of the concession agreement. That was done. We will wait for the assay results to come through on the EDX Douglas block later this year, early next. And then I think if there is, depending on sort of what interest or not as the case might be, if we were to have some interest from those assay results, then I think there would be motivation to fly sub-blocks of the full blocks in detailed areas as well. So short answer, no, only concession to date. Remains a viable tool for us. And if we have exploration success, then I would imagine that that's one of the tools we would roll out going forward in 2024.
Let's hope that's the case. Another comment here, with junior A miners having had their market cap smashed, is now not a good time for selective acquisitions before the market recovers?
I would say that sort of, we have a busy BD sort of profile now. I think that sort of, the ability to look at certainly early stage opportunities around exploration. There is a fertile ground now to potentially look to tie up JVs earnings with earlier stage opportunities. I think we continue to look at development opportunities, and then obviously continue to look at sort of producing opportunities as well. But I certainly would agree that certainly AIM and TSX the end of the market is that they are tough times for those companies. And that might be an opportunity for us to leverage our financial robustness, and also recognising the skills we have in terms of our exploration geological team. They've done some excellent work, both at Sakari and more broadly across Centamin, and a long track record of success prior to that as well. So yeah, that's something that we are actively pursuing at this time now. Yeah.
Wonderful. And are you confident you can maintain good business relationships with the Egyptian government?
Look, it's been a real focus the last couple of 3 years of building those relationships with our primary sort of interlocutor, the Minister of Petroleum, and then more broadly across other sort of Egyptian institutions as well. Look, I think it's something that we all like, that broad-based approach. I mentioned being a good corporate citizen, looking after our workforce, looking after the sort of all our stakeholders and partners' interests there as well. And yes, look, I think by being a good citizen, by doing the right thing for the short, medium, and long term, and sort of being visible there, engaging and listening, I think as a good partner does do, then I would hope that one could always maintain those good relations.
Thank you. And that actually brings on to another one, saying that there's been a rumour of a recent workers' strike. Has that been resolved?
And that would be news to me. There was a workers' strike. I'm certainly not aware of one. Ross, unless it's Ross has gone on strike in Jersey. Ross, are you on strike at this stage? Or?
No, absolutely nothing. That's all unfolded.
No strikes.
Are there any other associated significant minerals that you believe to be exploited alongside gold in Egypt?
Look, I would say very quickly on that one, Arabian-Nubian Shield, same on the Saudi side as it is on the Egyptian side. In Saudi, there's things like the Jabal Sayed mine, which is currently run by Marden, the state-owned company, and Barrick. They operate a copper-gold mine there. So that tells you that there's certainly copper-gold potential within the Arabian-Nubian Shield. Looking a bit further south, you might remember Nevsun, polymetallic operation down in Eritrea. That's at the bottom end of the Arabian-Nubian Shield. And one would say the Hasai mine in Sudan, formerly owned by La Mancha, that also was a polymetallic gossamer as well. So certainly the Arabian-Nubian Shield does, elsewhere outside of Egypt, host polymetallic and base metal operations. So as a mining engineer and orogologist, so I tread carefully. One would argue that there must be geological potential within Egypt for things other than gold as well, for sure.
Gosh, they just keep coming in. Sorry. Is it known where? Is it known where the ancient Egyptians used to mine for gold?
Yeah, look, I think there are good we know there are good historical records of known sort of mining sites. I mean, Sukari itself, we've known from an archaeological work that's been done over the last 12 months. We know that gold was being mined at Sukari during the times of the pharaohs. We've got evidence on the site away from the main pit. It's all fine. There's no barriers to operations, just to be very clear. But we know that gold has been mined there as well. So there are a number of sort of, if you like, known areas. Still lots of artisanal workings that are out there in the desert to be discovered, and it's one of the best tools you can use as an explorationist to go and find out where the artisanals have been and what they're left behind as well. So yes, I think there's been lots of research around this, and modern techniques using satellite imagery and airborne surveys will continue to sort of highlight those potential areas.
Great. Okay, so 4 more left. Is the market giving you value for Doropo? If so, what? And if not, why?
That's a very good question. I don't. Certainly the analysts are. Certainly the analysts are now starting to pay attention with the PFS, with reserves. I think that they are certainly coming through. Is that translating through from an investor perspective? I don't suspect so just yet. I don't think that is there. I think that's in for free at this stage, if I'm honest with you. I think as you move into sort of, feasibility stage now, post-feasibility, when you've got something that with a definitive, cost and path to cash flow, I think that's really when, one could really hope it sort of kicks into there. So I would say I don't personally believe it is at this stage. What do you think, Ross? But I think the feasibility that people have to.
No, I think so, Martin. I don't think it's fully factored in. It's coming to the fore, but not baked in.
I would 100% agree with that. Will expected improved future cash flow drive dividend growth?
Mr. Gerard, our CFO, with your framework of dividend, Ross.
I think absolutely, in terms of this balancing of as we navigate out of this peak capex period. We can see the end of that's falling off May, June next year. We're going to enter into some significant cash flow generation. It's that balance around having that flexibility with the RCF, having some treasury, getting some project level finance done at a Doropo project level, and balancing out all those pillars that we have ahead of us. But absolutely, I think we've navigated the peak of our investment now, and pick your gold price, fuel price as we go forward. But I'm very confident in terms of navigating that going forward, and the impact on what that means for both our investment in growth and our distributions, and our dividend distributions, and the way that's calculated is very transparent. So as you calculate and look at the cash flows going forward, I certainly would hope that it's on the up and positive.
Great, thank you. And then just one more request for clarification around the exit in Burkina Faso. More reference to the full year 22 annual report. There was a 2 million license renewal fee. That felt like a big amount. Could you elaborate a little bit more on what that was?
Sure. So sorry, I was on mute there, chatting away to myself on mute there. So that would have been the license renewal that was required as part of that. So just to sort of step back, we did the technical evaluation of Batty West. At that point, we could see a project that maybe had 800,000 ounces of reserves, around about a sort of 1.5 gram type head grade, and we felt at that stage that ultimately that wasn't a CENTAMIN style project, that maybe a very lean and hungry junior could make that work, but certainly it was not something that we would look to both spend our time and bandwidth or money on to develop it. That wouldn't sit. 100,000 ounce producer wouldn't sit within the sort of the CENTAMIN portfolio. The Ropo at 200,000 ounces clearly would do. So at that stage, this was still pre-coup. We decided to renew the licenses, sort of keep them current and valid, and then seek, if we could, an exit to try and sort of find a home for Batty West, with maybe a hungrier, smaller group that actually could be sort of meaningful for them as well. So we renewed the permits. We sort of launched into a process of trying to identify potential partners, either to acquire, earn in, or sort of effectively recoup some of the funds that we've invested in that project. And then obviously post that situation, then we sort of moved into the period of political instability. And with that, obviously the prospects of finding a company that would take a smaller project on in a country that had been suffered a double coup effectively was then incredibly challenging. And with that sort of political and security situation worsening, with a marginal project and inability to find that's when we made the decision to effectively hand that back. The $2 million fee to government, at that point, you've already invested quite a substantial amount of money into the project, both in terms of drilling historically and so on, and that was really a defensive move to see if we could, find that exit for ourselves at that point. And obviously, to find an exit, you have to have a valid license package as well. So unfortunately, political and security events moved against us. We paid the fee to governments, and that will be disclosed in our report, as you said. And then events moved against us, unfortunately, and that was, and then that had to be written off. Hindsight is a wonderful thing, as we all know. We'd obviously foreseen the coming political and security storm, then maybe we would have just relinquished the project there and then handed it back and walked away. But that was the background there. So an unfortunate turn of events for Burkina Faso itself, clearly, and then that relinquishment, post that relinquishment, would just be in the normal wrap-up and wind-up mode in terms of those fees from there.
Thank you. Just to clarify that, Martin and Alex, I think if you're referencing I think the total spend was 2.9 million, but not all of that is pure licensing. That would be the total spend in Burkina for that period. I don't know exactly, but it wasn't all just licensing.
Yeah, there'd have been a license renewal, Ross, and then, as you say, we took the decision at that point to renew the permits and the licenses on the ability that we could try and divest of the project a third party, but moved against us at that point.
Yeah.
Well, thank you for that clarification. And then just the last question. With gold heading to an all-time high and the CENTAMIN share price near lows, what catalyst can you get people excited about in the near term to regain some confidence in the market?
I think so. Look, I think in terms of immediate near term is that EDX sort of results to come through. I think let's wait and see what happens there. I think that's obviously a near term. We have our resource reserve update later this year. Obviously, we'll be publishing an update on both Sukari and the Doropo resources, Sukari resource and reserve of the Doropo resources. Then looking into next year, the finalisation of the capital waste stripping, that's finally behind us, the connection to grid, to deliver those cost savings from there as well as we go. So look, I think there's a number of catalysts as we go forward. One would hope and pray that that's in terms of the humanitarian issue that's happening in the region now, that's accompanied by a stabilisation and a calming of the current situation, and continue to sort of push that good news that we're delivering into hopefully a more stable market, more stable region, and improved conditions for the market as well.
That's great. Alex, thank you very much indeed. Ross, Martin, thank you for your time as well this afternoon. I know that investor feedback is going to be important to you both, and I'll shortly redirect those on the call to give you their feedback. But I wonder, before doing so, if I may, Martin, just come back to you for a few closing comments.
Thank you very much. Well, look, thank you everybody for taking the time to listen in. Hopefully, a bit more colour on the sort of situation. Look, I think a huge amount of significant positive work has been done right across the portfolio. I think it's a very different business today than it was 3 years ago. I've got personally a lot of confidence looking forward at both Zucari and EDX and the prospects for Doropo as well. And as I say, it's a number of near-term catalysts coming up over the next 6 months that will continue to hopefully drive a recovery in the share price. So thank you everybody for the time for listening in. If there are any questions that are unanswered, please feel free to reach out during the usual channels, through the website, through social media, and then via Alex or ourselves. I'm happy to try and engage with many of you as possible and get those questions back to you.
That's great, Martin. Thank you very much indeed. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the team. On behalf of the management team of CENTAMIN PLC, we'd like to thank you for attending today's presentation, and good evening to you all.